How low can oil go and how low can iron ore go? How low can the Australian dollar go as a consequence of that? Of course, a year ago when we said these things, everyone would say, oh, we just don't think that'll happen. I mean, oil has actually fallen much further than we think it would fall. The basic rule is however low you think it can fall, it will probably fall lower. The other basic rule is that once it fell to a point where, for example, we wake up on the 1st of January and oil and iron ore or whatever price they're at, the natural inclination, the optimist inside all of us, wants to believe that that's the lowest price that these things are going to fall to. That is how the human brain is conditioned. It is an optimistic thing to move forward with life. However, iron ore will fall to where it needs to fall to before it reaches equilibrium, and so will oil. And as we see things at the moment, these trends simply have not ended. They're still in free fall. But most importantly, if you're looking at companies that produce iron ore and energy, when you see the half-year results, the earnings are going to be significantly worse. But more important than that, when you see the full-year results, they're going to be significantly worse than that again, because there's a lag effect from when the prices actually started falling to what people are receiving in revenue. So a lot of these forward sales will have now ended, and new contracts that get written in with oil or gas or iron ore will be written at today's price, and today's price is much, much lower than a year ago. Well, I think since we spoke last time, the interesting thing is that the debt, portions of the debt, I think from memory it's about $9 billion of debt, and the company's trading about $4 or $5 billion, the equity. Some of that debt has traded in America at 60 cents on the dollar. That says that people are prepared to sell their debt at less than the face value that's owed to them. Now, if the debt isn't worth $1, in the old days in textbooks, you used to say if the debt's not worth $1, then the equity's worthless. So then the issue becomes the equity is actually a call option on some sort of survival in the future. Would you pay $5 billion for that call option? We wouldn't. That's maybe another way of looking at Fortescue. If someone's paying for a call option that the $9 billion of debt is going to get paid in the future sometime, and we will then go on to create another $5, $10, $15 billion of cash flow to reward us for the risk that we're taking, we wouldn't take on that risk. We see that someone else in some other sector who trades debt is prepared to sell that debt for 60 cents on the dollar. That must be, in the light of day, a warning signal to people on the value of the equity.